Bloomberg Audio Studios. Podcasts, radio, news.
Hello, and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Welcome back, Katie.
Welcome back, Matt. You didn't go anywhere, but in my mind, I took a vacation from
me.
Yeah, it's been a minute.
For the listeners, service has continued uninterrupted, but for us, it's been 2 weeks.
I know. I had to remember how to anchor television this morning. I'm currently trying to remember how to record a podcast.
Yeah, no, I also forgot in our week off. It was honestly nice.
Yeah. The way this usually goes, though, is we have 3 topics.
Sure.
Yeah.
What are those 3 topics today, Katie?
So we're going to talk about Endeavor. You're on a 3-day streak of writing about this deal.
It's quite an endeavor.
We're going to talk about the baby Berkshire boom, because that is underway. And then we're going to talk about public-private prices. Endeavor. I think when we first spoke about this deal, we ended with something close to watch this space because it was going to close on March 24th, and it did.
Right. And it's funny, like, I sometimes will write an M&A deal will have a lot of drama, and so I'll write about it successively for days or weeks. Nothing's really happened in this deal. Like,
just the
deal
anticipation.
closed on Monday, like nothing's happened since. Like, this company doesn't exist. Right. So Endeavor is a company. Mm-hmm. It went private. There was like a long lead up to it going private. Like, they signed their deal about a year ago. Silver Lake, the biggest shareholder, agreed to take it private at $27.50 per share. And they announced a few weeks ago that it was going to close this Monday, March 24th. And then this Monday, March 24th, it closed at $27.50 per share, exactly on schedule. So not really a lot of news there. But what was weird is that the previous week, it traded well above $27.50 per share. And in fact, the last day before the closing on Friday, it closed at $29.25 a share, so like $1.75 over the merger price. And like a lot of shares traded. And, if you know you're going to get cashed out at $27.50 on Monday, it's a little weird to buy the stock at $29.25 on Friday. And, the reason for that seems to be that everyone expects there to be a class action lawsuit saying that the deal was underpriced, and they're looking forward to getting in on that class action. Yeah,
you had 3 possibilities.
Yeah. So when we talked about this last time, there was a lot of noise about appraisal. Which is one way you can basically sue for a better price. But to do that, you have to demand appraisal. And there are reasons that can be advantageous to you. But one problem with it is you need to have owned the stock continuously since early February. The other way to sue to get a better price is just a class action lawsuit saying that the board that approved the deal was failing in its fiduciary duties to shareholders. And here that's a pretty tempting lawsuit because, as we talked about last time, the deal price turned out to look really low. Endeavor's main asset is shares of another publicly traded company.
Right.
And that company traded up a lot. So by now the deal price for Endeavor looks really low. And, it's being bought by its controlling shareholder. So there's always a conflict of interest there. There wasn't a vote of the independent shareholders. No independent person really ratified the price, right? The board did, but the shareholders didn't. So, there's a lot of stuff for a lawsuit, and people seem to be valuing that lawsuit at about $1.75 a share.
Well, clear this up for me because I was a little bit confused. So there's a possibility of a class action lawsuit, but that is different than appraisal.
Different from appraisal, yeah.
Okay.
Appraisal is this price should have been higher, right? It doesn't require any allegations of wrongdoing. The class action lawsuit is the board didn't do its fiduciary duty for shareholders. But in this sort of conflicted situation, they almost get to the same place, and it's a little bit easier to do the class action because you don't have to have held the shares continuously.
So your third explanation was?
People might have thought that Silver Lake would recut the deal to give people a better price, but I don't know why they would have thought that because Silver Lake did say they wouldn't do it and then they didn't do it. So.
So it looks like the possibility that your readers seem to agree with was that maybe you bought the stock betting on this lawsuit happening.
You bought the stock thinking a lawsuit would happen and that you wanted to be in that lawsuit because you thought that lawsuit was worth more than $1.75 a share.
Maybe that's what Carl Icahn did.
I would be surprised if there was any other reason for it. But yeah, Carl Icahn bought about 8% of Endeavor. Mm-hmm. It's not exactly clear when because the disclosure doesn't have like the trading records, but it kind of seems like he bought it all on Friday.
As of Friday, he had 8.4%.
Yeah, and there was a lot of shares traded on Friday. Like he might have bought all of his shares on Friday. Might have been why the stock spiked. But in any case, yeah, he seems to have bought the stock fairly recently, and he's Carl Icahn. Mm-hmm. Like, he doesn't mind a lawsuit.
No.
He doesn't mind getting his hands a little dirty. And, you know, I wrote on Thursday, like, if you're a shareholder who was hoping to get in on a lawsuit, like, you got to feel good about this, right? He's going to have some fun with that lawsuit.
Yeah.
You want Carl Icahn on your side complaining about the deal price? I don't know. It seems like an encouraging fact.
Makes for good TV, makes for good podcasting.
Yeah.
So perhaps Carl Icahn wanted in on this lawsuit specifically, but there's also the possibility that maybe short sellers wanted out, ?
I really don't know. There's a weird, fascinating history of this. So like this is not the first deal that has kind of gone like this where there's been a going private transaction. It looks kind of conflicted. Shareholders are disgruntled. The stock trades above the deal price right until the last minute. And then the deal closes and the shareholders sue. And like years later down the line, they win their lawsuit and they get some money. In that case, if you see a stock trading at $29 a share and you know that it's going to be cashed out at $27.50 on Monday, mm-hmm. you might be tempted to sell that stock short because you sell it for $29. You pay back the $27.50 on Monday, you make an easy $1.50. So in a lot of these deals, they end up, the deal closes and there's some number of shorts, and the shorts make a quick profit because the deal closes at below the last trade price. And so like if they shorted it above the deal price, they make a quick profit. And then they go about their business. And years later, the class action lawsuit gets decided in favor of the shareholders. And someone, like their broker, comes to them and says, remember that deal that closed at $27.50 and you paid $27.50 because you were short? Actually, the real deal price is $32. So you owe us another $4.50.
Uh-oh.
There's a lot of like lore on this, and it's not clear like what the actual rules are. My understanding is there are people who have done this trade, and like years later, the brokers have come to them and said, you owe us more money. And they've said, no, we don't. We closed out our short. Mm-hmm. What are you even talking about? This is not a corporate action that we owe money on. And there are some like FINRA arbitrations where the customers and the brokers have gone to arbitration. And it's kind of, I think, gone both ways. There are some where the customers have lost, but some I think where they've won. So there's like an interesting trade here where you can like make a free, risk-free profit on your short and then years later try to stiff your broker so you can keep the profit. But it's, you know, a little dicey.
Yeah. But I don't know, for a good 2 to 3 years, you did make a profit on that. And that has to feel somewhat good.
Yeah. I get a lot of emails from people being like, what if I did this? What if I like moved out of state? You know, like, there's a lot of ways, you know, it's easy to imagine how you would avoid your broker's phone call in 3 years, right?
Yeah.
So I think people are interested in that trade.
Okay, so where does this go for here? Like you said, usually...
So what is the suit? I keep looking for the lawsuit. I haven't seen like the lawsuit.
The class action lawsuit.
Yeah. Usually, like, you know, lawyers are putting out press releases.
So why is that more likely, just judging from the tone of this conversation, than appraisal?
Oh, just because, like, so many shares have traded hands after the appraisal deadline. So, like, if you're buying shares at $29 last week, you couldn't be doing it for appraisal because you wouldn't get appraisal. You have to be buying into the class action.
Could there be both?
There could be both.
Okay.
The big case that I wrote about was Dole. And there were both appraisal. They're not the same thing. And you could imagine an appraisal court saying, oh, the actual value of the company was this. And the class action court saying, oh, like the fiduciary duties, you know, were violated and that's worth this. You know, like they're not the same thing at all. But like, you know, they're kind of roughly the same idea, which is you underpaid for this company, give us more money.
Mm. So it seems like this continues to be a watch this space situation. There's the promise of drama. It just hasn't necessarily happened yet.
It would be weird if nothing happened because people were paying for drama, right? Like
that'd be kind of beautiful, though, if truly nothing happened.
Right. If everyone was like, I think this is a $1.75 a share lawsuit, I'm looking forward to that lawsuit, and no one actually remembers to file the lawsuit and just goes away.
Icahn was just like, I don't know, I felt possessed to buy 8.4% of these shares on Friday.
Icahn was like, I was hoping someone else would bring a lawsuit, but it's not worth it to me.
I'm feeling shy now.
Yeah. I told you that I went to the Bluey experience at
We've almost
camp.
certainly talked
about it on
about
the
this.
podcast.
Did I remember that? No, but tell me about it.
They like built Bluey's house in a building near Union Square.
That sounds kind of fun.
I really like Bluey. It's a good show.
Yeah, I can't
I
wait
feel
to
like I
have
like
my
it more than
own
my kids do,
children to watch Bluey.
Bluey is very much like a show for parents.
Yeah.
It's very mature.
You know what else is
Very mature. The private equity business model.
Yeah.
Oh, yeah.
Oh, here we go. What do you got?
What do I got? KKR. They've got
KKR.
strategic holdings.
Yeah.
Not just regular holdings, but strategic holdings.
Holdings that they will hold for a while is the plan.
Decades.
Yeah.
Yeah.
They've got about 18 of them.
18. Yeah. Right. So KKR is like historically a leveraged buyout firm where they manage funds. They raise funds from limited partners. They take those funds and they write equity checks to do leveraged buyouts. They borrow money to buy companies. They take over the companies. They lever them up. They improve their operations. They strip off the stuff they don't want. They incentivize managers. They get everything all nice. And 3 to 5 years later, they take them public again or sell them and get a big check that they return to their limited partners and, take 20% for themselves. Like that's the traditional LBO business model. And, all these like LBO pioneers of the 80s and 90s like are now giant public companies like KKR, and they run funds for investors. Like now the term is alternative asset managers because they do a lot besides classic leveraged buyouts. But they still basically do that kind of model where they run funds and take 20%. And KKR is shifting, let's say, or like introducing more of a model where what they do is they just, on their own balance sheet as a company, buy stakes in companies or infrastructure projects or whatever, and just own them forever. And they're just part of the company. They're like a big industrial conglomerate. It's an interesting shift.
Yeah. The logic here, I mean, looking at Allison McNeely's story, KKR has this plan to quadruple its earnings per share over the next decade. Strategic holdings would be a strategic part of that. They also want to build a portfolio that kicks off more than $1 billion a year in dividends. So it's different from the fee model, of course.
Yeah,
but
it's, one thing I read is that the ultimate success for a hedge fund is to get rid of all of your outside investors and convert to a family office because you've just made so much money for yourself that you'd rather earn 100% of the returns on your investments than like 20%. Right. This is like a little bit like that, right? The fee model is good enough that KKR has made a lot of money.
Yeah.
And where do they do with that money? Well, one thing you do is you transition from being a service provider who collects 20% to being just an asset owner and a capitalist, right? And you just own the companies instead of owning the 20% promote on them. That's like one way to analyze what they're doing here is like, it has been a good enough business for long enough that now instead of KKR being like, we're going to manage funds to buy companies, they'll be like, we'll just buy the companies. But it's different from being a family office because like most hedge funds are like, the hedge fund management company is privately owned, and transitioning to a family office means like the guy who owned the hedge fund now owns all the investments. Here, KKR is not like a guy or even the three, Kohlberg, Kravis, and Roberts. It's a public company. So the public company is sort of becoming its own family office, and like the public company is going to own all these investments directly rather than taking fees to run a fund.
in a way, it's beautiful. Just the natural evolution of things. Don't we all aspire to something similar?
In some ways, it's like the whole private equity business has done this, right? Like private equity was like a small, scrappy business taking over like poorly managed companies and like making them more efficient. And that was like so wildly lucrative for so long that now it's like, we have all this money. We could just own the companies ourselves. We don't need to run funds anymore. Like that's not, it's an exaggeration because most of them, including KKR, mostly run funds. But like there's this shift to like we can own stuff on our balance sheet.
Yeah. In a way, I feel really drawn to this. I think I've talked before on this podcast how I really like and admire the old school strategy of just stock picking. This is a little bit different, but,
yeah, but you're right.
It's sort of the same basis.
Right. Like old school private equity is like, people in it would disagree with this, but like it's a financial engineering story, right? It's a like, we can put more leverage on this company than the public markets can, right? But this is like, yeah, we like that business. Let's own it forever. Yeah. Let's never think about it again.
It's going to compound over time and become better. And you just got to be patient. And we're going to hold this for a few decades.
Right. No, I'm with you. I also admire the business. to my mind, like, what better job could you possibly have than like waking up and being like, here are 12 stocks I want to own. I will buy them and my job is over for the rest of my life.
The answer is right in front of you. Being a podcaster, obviously. But I take your point. I find it really compelling. Yeah. And of course, this comes as KKR has phrased this. The co-CEO said at Bloomberg Invest earlier in March that basically it's in some ways to become a mini Berkshire Hathaway.
Sure, mini Berkshire Hathaway.
Everyone wants to be Warren Buffett, including friend of the show, Bill Ackman. I think it is interesting that you do have at least a size of two folks saying that we are basically wanting to model ourselves after Berkshire Hathaway.
You're so young. I feel like,
well, you know,
people wanting to be Warren Buffett is like a long-standing. I was thinking about
but
this,
in
like,
the past,
like Joe Bay and like Bill Ackman grew up in a world where like the pinnacle of investing was Warren Buffett, right? Like, I do wonder if like, the kids these days want to be Warren Buffett. But
I don't know. There was that time during the pandemic where Buffett was getting dunked on a lot by like the Dave Portnoys of the world. But I feel like he's back in vogue.
Well, he's certainly in vogue among friend of the show.
Bill Ackman.
Like that crowd.
Yeah.
No. Why wouldn't you want to be Berkshire Hathaway?
I want to talk about their current lineup of investments. So as I mentioned, 18 includes lens retailer 1-800-CONTACTS, which actually texted me today to tell me that it's time to order $800 worth of contacts again. Cybersecurity company Barracuda Networks, also Australian snack food manufacturer Arnaud's Group, Arnott's Group. But anyway, again, it's just, I mean, 1-800-CONTACTS, that's a household name, but it's cool because it's not like flashy, like AI sort of stuff, at least from what I can tell from Allison McNeely's article.
Yeah.
I could keep going.
But those are sort of like, you know, those are like classic private equity kind of investments, right? Like, like unglamorous, like nice cash flow kind of companies. But, you know, now they just own them directly.
Yeah. For me, an absolute consumer staple. Just talk about 1-800-CONTACTS.
You are a reliable source of cash flow for KKR's strategic holdings.
Just a little more color there. They own an average 20% stake in these 18 firms. That is about $3.7 billion of revenue, $900 million of adjusted earnings, which is a small share overall of their operating earnings right now. But they're predicting that strategic holdings will generate $1.1 billion by 2030.
The main way I think about this bet is like when you generated enough money doing a like high fee, high return financial services business, like you can just use that money to own things yourself. But there's also like, you do wonder if there's like pressure on those fees or those returns, right? Like private equity in the 80s, there's a lot of low hanging fruit. Later vintages of funds have not always returned as well. And like, you know, people talk about how there's pressure on private equity exits now. And you don't hear a ton about fee pressure in private equity, but you hear that some every now and then. Like, you might be one of these alternative asset managers looking around and saying, like, you know, the long-term trend of like financial services fees are like, you know, Katie Greifeld keeps telling me that you can get an ETF for 1 basis point.
It's coming.
If you think like, you know, in 20 years, what will our earnings mix look like? You might say like, we might earn less in fees, but we'll own all these companies that like sell contacts to Katie Greifeld. And so we can get our money that way, right? Like if you think that fees over time will come down, like owning businesses is the way to avoid that.
So they're future-proofing in a way. Yeah. Man, if I could go back to the 80s.
It's like anything, like private equity like feels really institutional now. But if you're on like, I always think like if you're on like a crypto exchange, like you gotta like take all that money and put it into like laundromats or like, you know, like real businesses, you know,
vending machines.
Yeah, vending, because you can't rely on like that like lottery winnings to keep continuing, but like you can put the money into a real business. You buy like land. I don't know.
Oh my God, yeah.
Yeah, they're buying land. They should buy land.
Everyone should buy land. I would love to be land rich. Okay, so we have been talking for months, really the entire existence of this podcast, about how private markets are becoming public. Private markets are the new public market. And now we have some prices to put to that. I
really feel like it's a big step in private markets becoming more public when Yahoo Finance starts putting up like daily or, you know, like real-time real-time-ish stock charts of SpaceX and OpenAI, Stripe, and 97 or so other private companies that don't trade on the stock exchange, but that are tracked by enough like private company tracking kind of things that they can be like, oh, here's a stock price chart. And so you can go look at a stock price chart of all these companies. And that feels like, you could read news articles that were like, secondary trading suggests Stripe's value is blah, blah, blah. But like now you can just go look at a chart on your Yahoo Finance. Seems like a big difference. Seems like a real step toward making them look public. I
appreciate the effort. It's like in opening volley. I don't think these prices are perfect.
No, they're fascinatingly imperfect, right? So like these prices, Yahoo gets them from two marketplaces.
Right.
Two companies that provide a marketplace for, like sort of employees, ex-employees of these companies to sell their stock to like
Forge and EquityZen.
Yeah, Forge and EquityZen. Basically, it's like on the selling side, you have like employees and ex-employees of these companies who want to exit. And on the buying side, you have dentists, right? Like that's roughly the model. And I was like, those trades have to be like illiquid and small and, driven by weird dynamics and not really reflective of valuation of these companies. But if you look at how these prices are derived, they're not really derived necessarily from those trades. Like these prices are sort of like algorithmically determined from things like funding rounds and tender offers and also like bids and trades on these platforms, but it's unclear like how the prices are determined. And you look at some of these companies and the prices like don't change very much. And it's just very clear that they're sort of essentially pulling in like prices from funding rounds and tender offers. And it's not a real-time stock chart. It's like Crunchbase in chart form, it's like prices of funding rounds. It's not like real-time secondary market trading prices.
Which again, I appreciate. But then you take a look at OpenAI's chart, for example, as you mentioned, it is pretty flat.
Yeah.
It's pretty flat, which is funny and probably, again, not reflective of real-time pricing when you consider the news this week that they're close to finalizing a 40...
Sure, but there isn't real-time. Like OpenAI stock does not like really trade among... like on these secondary trading platforms, right?
Yeah, I know, but I'm saying it's an example of how
pretend real-time price.
Not real-time this is. They're close to finalizing their $40 billion funding round, at least according to Bloomberg reporting. That would value the company at $300 billion. If this was close to real-time, I would imagine you would see the line wiggle a little, but it hasn't.
Right. It's like psychologically interesting to have like what looks like a real-time price chart, even if it's not a real-time price chart, because it just makes you think, ooh, that's a company whose stock I can buy. And by the way, you can't necessarily, right? Like the other thing
you
is
can try hard.
These platforms are like places that will let you buy many of these stocks, but it doesn't mean they have stock to sell you, right? Like, these companies often try to restrict their, employees and investors' ability to resell stock. The news this week is both that Yahoo Finance is taking prices from EquityZen and Forge to like show these stock charts, but also that EquityZen and Forge are lowering their investment minimums so that now you can, if you're an accredited investor, you can buy stock in these companies with as little as $5,000. But again, like that's just like their rules. It doesn't mean that someone's going to sell you $5,000 of SpaceX stock. And in fact, I think it's kind of hard to source a lot of the like really hot private companies on these platforms.
So I'm comparing, I hate to talk about ETFs. I just hate it, Matt. But I'm going to do it right now. I know that there's a subset of listeners who absolutely hate when I bring up ETFs, but I just came back from an ETF conference and we have a lot of fans there. So shout out to the friendly couple that stopped me in Las Vegas in the casino in the Virgin Hotel. In any case, there is this ETF called the ER Shares Private Public Crossover ETF. The ticker is XOVR, crossover. It actually, 10% of its portfolio is SpaceX.
Sure.
This is pretty much meaningless, but you take a look at the performance of this ETF, it's down about 7% on a total return basis year to date. And SpaceX, at least according to Yahoo Finance, is at least up slightly. According to Yahoo Finance, it went from $2.11 per share to just under $2.15 per share. Again, this is very close to a meaningless comparison, but there is some way, I guess, you could back into what SpaceX is doing. Not really, but
not really.
I do think it's a little bit interesting. You do have this ETF with real-time pricing. We know that 10% of it is SpaceX.
Yeah, but that doesn't give us real-time SpaceX pricing.
No.
Because, like, I don't know how, like, people do the ARB, but, like, I assume that, like, Jane Street is not, like, delivering a basket of a little SpaceX stock to, like, get shares of X over, right? Like, in some ways, like, this stuff where, like, Yahoo is putting up price charts and, like, you can theoretically get into these private markets with as little as $5,000. Like, in some ways, that is, like, psychological signaling rather than, like, a real thing. And it's not like you can go buy $5,000 worth of SpaceX and, like, there's a real-time chart on Yahoo. But in some ways, it, like, is pushing it towards being a little bit more real. Mm-hmm. So, like, private markets theoretically are open only to accredited investors in the US, whereas, like, public markets are open to everyone. But if you look at, like, the number of people who are accredited, because, like, the accredited standards have not gone up since, like, the 80s. Like, to be accredited, you need to have, I think, $200,000 a year of income, or $300,000 as a couple, or like $1 million in assets. Mm-hmm. And that works out to something like 20% of the population, which is, like, roughly the percent of the population that, like, own individual stocks and brokerage accounts. So the investor class that, like, buys public stocks and the investor class that can legally buy private stocks is, like, kind of the same class, kind of.
Yeah.
You do wonder a little, like, what is the need for a company to go public? And then conversely, like, what is the need for it to stay private, right? Because, like, one thing that CEOs sometimes say is they don't like the distraction of having a public stock price, and, like, they don't like managing to the stock price, and they don't like the short-termism of, like, the stock price reacting to news.
Yeah.
And, like, now you have the stock chart on Yahoo Finance. That doesn't move very much. But, like, you know, in the future, if it moves a lot, you might be like, I might as well just go public because my stock price is public anyway, you know? I don't know.
Another counter to that would be, though, that they don't have to report earnings 4 times a year.
It's wild to me that, like, basically retail investors can put $5,000 into a stock and there is no expectation. Nobody cares at all that they will ever see financial statements for the company.
Yeah.
Right? And, like, of course, no one
who
buys stocks in a brokerage account looks at financial statements for the companies they buy stock in, right? So, like, of course it makes sense that no one cares about seeing financial statements. But it's weird that, like, we have, like, 100 years of securities law that's based around, like, we need full disclosure about a company. We need, like, audited financial statements to allow people to make informed investing decisions. And everyone's like, no, we don't care about that stuff. We'll buy SpaceX. Doesn't matter.
But you could indirectly say that, you know, they need them and care about them because they form the basis of a lot of great articles written by financial journalists who do read the financial statements, et cetera, and do the work.
That's definitely the theory of, like, public markets, is that, like, there is a lot of work done, you know, including based on, like, regulated public financial disclosure. There's a lot of work done to make prices efficient. So when you buy stock in your brokerage account, you are probably getting an efficient price, right? Like, you're paying sort of roughly the, you know, market expected fair value of the company. With private companies, like, you could probably make similar arguments, right? But, like, not really. The financials are not public. Institutions are not necessarily, like, trading in the secondary market in large size. Like, you're sort of drafting on, like, venture capitalists valuing the company in funding rounds. And, like, the incentives there are not quite, like, it's not quite the same thing as in public markets where there's, like, you know, informed people on both sides of the trade.
Yeah. Funding rounds obviously are the basis of these Yahoo Finance price charts.
Not all of them, supposedly.
But I don't know.
There's, like, secondary market trading. But yeah, no,
looking
I agree.
at OpenAI,
I
mean, so much has happened in the AI landscape. There's no pricing of what happened with DeepSeek, et cetera.
Right.
So,
right.
Like, I don't
it would
see...
be really funny. It would be really fun. Like, if when the DeepSeek news had dropped, if you could go to your browser and look at a real-time stock price for OpenAI.
Yeah.
But that would be really, really funny if, like, it was just a flat line. And you're like, wait, where's the reaction?
We are actually pricing in all information that we have available to us at this time.
I will tell you, the other big OpenAI, like, stock price thing, the other thing that, like, you would expect
if there had been a real-time stock price
was when they fired Sam Altman for a weekend.
That would have been fun.
I wrote about it at the time. They had just done... I think they finalized, like, an employee tender, I think, at, like, an $84 billion valuation, I think. And they were almost done. And then, like, they fired their CEO.
Yeah.
And then, like, you know, 2 days later, they hired him back. And then, like, they continued doing the tender. And then, like, they finalized it. And I think it was still at $84 billion. And I read about, like, what a weird fact that this news didn't change, like, in either direction, didn't change the valuation of OpenAI.
It was perfectly priced in.
It was just like, all of it was as expected. Everything's totally normal. This is not really true. And then, like, you know, they like very quickly went on to raised at much higher valuations, actually. This is my way of saying, if you looked at a real-time stock chart of OpenAI during DeepSeek and it didn't move, you might be like, oh, that's right. That's how like venture capitalists think about OpenAI, just a flat line.
You know, and it's still flat this week, even with Studio Ghibli. You can do that on ChatGPT right now.
That's really cool.
Well, it's all over my Twitter feed, my X feed right now. I feel like you don't really...
I'm not on X.
You're not an Xer.
Yeah, I'm an Xer.
Well, that's what you can expect if you go there right now. But maybe that would have pushed the stock price higher if these were real.
Isn't it nice?
Go on.
Like you saying like it's all over my X feed makes me think like I understand why CEOs don't like to have a real-time stock price. It's like, this distraction has moved around our stock price. It's like, let's just not have that.
So I talk to a lot of CEOs in my other job, which is being a television anchor. Sure. And you ask them on air, do you care about the stock price, or did you notice this in the stock price? And they always say, no, I don't really look at the stock price, blah, blah, blah. And then you get lunch with them. You get coffee, you ask them in the commercial break, and I often get from them, yeah, I'm constantly watching it. And of course you are. If I had a real-time measure of my performance, I would never not be looking at it, which I guess is distracting.
This is like Cliff Asness's theory about private equity, which is that like it is not less volatile than public stocks, but it reports less frequently, and so it feels less volatile. And so everyone knows that. But his point is like that is actually valuable to a lot of investors, and that's why they're willing to pay a premium for private equity, because like not knowing what the stock price is like really good for you.
I mean, probably, but right. I would never not check. I read every YouTube comment. I read every Spotify comment. I look at every tweet tweeted at me. I just am desperate for feedback.
And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Andam. And special thanks this week to Cal Brooks.
Our theme music was composed by Blake Maples.
Brendan Francis Newnham is our executive producer.
And Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.